There's a pattern unfolding right now in 2025. Most people can't see it, but those who understand history know exactly what comes next. Since 1997, economist Fred Fold-Very has predicted economic collapses with unsettling precision, including forecasting the 2008 crisis 11 years before it occurred. Now, multiple forecasters are warning that 2026 represents the next inflection point in an 18-year real estate cycle. But this isn't about real estate. This is about the systematic destruction of global reserve currencies. What happened to Spain in the 1500s? What happened to Britain in the 1930s? What happened to America in 1929 and 2008? It's happening again, right now. And 2026 isn't a prediction. It's a mathematical inevitability. The pattern has 5 stages. Every empire that has ever held reserve currency status has moved through these 5 stages with mechanical precision. Spain took 150 years to complete the cycle. Britain took 80 years. America might complete it in less than 50. We are currently in stage 4. Most people think the economy recovered after 2008. They believe the system healed. They trust that central banks learned their lesson. They are catastrophically wrong. As of November 2025, U.S. national debt stands at $38.09 trillion, increasing by $5.97 billion per day, U.S. Senate. That translates to $288,101 in debt per household. Total public debt now equals 122.6% of GDP, U.S. Congress Joint Economic Committee. This isn't government mismanagement. This is stage 4. And stage 5 is asset price collapse, currency devaluation, and the end of dollar dominance. The people who see this pattern coming will protect themselves. The people who don't will lose everything. This video will show you the pattern, the documented history, the 5 stages that repeat with mathematical precision across centuries. And it will show you what very few people understand. We are not heading toward the pattern. We are it. Let me show you the pattern that destroyed every reserve currency in history. It's not theory. It's not speculation. It's documented across 5 centuries of imperial collapse. The 5 stages of reserve currency collapse. Stage 1, productivity dominance. The empire builds. It innovates. It produces more efficiently than any competitor on Earth. Its currency becomes the global standard because the world needs what it makes. In the 1860s, Britain absorbed over 30% of global exports. The world ran on British manufacturing. Spain controlled vast silver mines in Potosi and Zacatecas during the 16th century, flooding global markets with the Spanish real. America reached this stage after World War II. Dollar dominance was earned through industrial capacity that rebuilt Europe and Asia. This is the golden age, but it doesn't last. Stage 2. Financial overextension. The empire stops producing and starts consuming. Manufacturing moves offshore. Imports exceed exports. The trade deficit widens. But the currency stays strong because the world still needs it for transactions. This creates a dangerous illusion. The nation can spend more than it earns because others accept its currency. It can pay for things by writing checks that nobody cashes. This is the privilege of reserve currency status. And it is a trap. National expenditure in the U.S. exceeded national income by more than 20% over 5 consecutive years. The empire borrows to sustain consumption. Debt accumulates. But interest rates stay low because foreign central banks need the currency for reserves. This can continue for decades, until it can't. Stage 3, debt saturation. Debt grows faster than the economy. U.S. debt now stands at 122.6% of GDP, U.S. Congress Joint Economic Committee. Debt has doubled approximately every decade since 2000, accelerating from $5.7 trillion to current levels. Interest rates on federal debt have more than doubled since January 2022, rising from 1.556% to 3.352%, Pew Research Center. The mathematics become inescapable. Net interest as a share of federal outlays is forecast to reach 13.85% in fiscal year 2026, then 14.11% in 2027, and 14.52% in 2028, U.S. Congress Joint Economic Committee. More money goes to interest payments than defense, than infrastructure, than education. The debt spiral accelerates, and markets begin to notice. Stage 4. Loss of confidence. This is where we are now. Foreign central banks quietly diversify away from the reserve currency. Bond auctions weaken. Yields rise. The cost of borrowing increases. Economists warn that by 2024, U.S. debt will grow so large that U.S. bonds may no longer be considered safe. Recent analysis identifies repeating hallmarks of collapse: extreme asset valuations, unprecedented retail participation, debt saturation, and institutional hedging into gold and Bitcoin. Institutions move first, quietly, without announcement. Sovereign wealth funds reduce dollar holdings. Central banks increase gold reserves. Corporations hedge currency exposure. By the 1930s, sterling's reserve currency status was maintained largely through imperial balances held by British colonies, not by major economies. When confidence erodes, it accelerates. Stage 5. Collapse and currency crisis. The final stage arrives suddenly. A trigger event, war, banking crisis, sovereign default, exposes the structural weakness. Markets panic. Capital flees. The currency devalues. Following the 1931 sterling crisis, the share of foreign exchange in total global reserves collapsed from 36% to just 8% within 2 years. The collapse of asset prices precipitates the crisis, as excessive debt built up cannot be repaid. Bond markets freeze. Interest rates spike. The government can no longer borrow at sustainable rates. This is not a recession. This is imperial collapse. Let me show you how this pattern played out 3 times in documented history. Spain, the Silver Empire, 1500 to 1640. Stage 1 began with conquest. Spanish control of silver mines in present-day Bolivia and Mexico gave them the world's reserve currency. The Spanish real became widely accepted due to its uniform weight and high silver content. Global trade ran on Spanish silver. But Stage 2 arrived within decades. The influx of gold and silver from the New World caused massive inflation throughout Spain and allied European countries. Spain consumed rather than produced. Manufacturing never developed. The wealth flowed to the rest of Western Europe through Spain's balance of payments deficit. Stage 3 was debt. Charles V imposed a vicious circle of borrowing that progressively weakened Spanish finances, leading to sovereign default in 1557. Spain declared bankruptcy. Then again. 3 times in 50 years. Stage 4 was imperial overextension. Wars in Europe. Colonial rebellions. Naval defeat. Stage 5 was total collapse. The Spanish real lost reserve status. The empire fragmented. The currency became worthless outside Spain. The pattern was complete. Britain, the Sterling Empire, 1815 to 1967. Britain Stage 1 was Industrial Revolution. British industrial goods dominated global markets, with Britain absorbing over 30% of world exports in 1860. Britain exported nearly £4 billion in capital by 1913. Sterling was everywhere. Trusted, stable, backed by the world's largest navy and the gold standard. Stage 2 began after World War I. The 1920s in the UK brought depression, deflation, and steady decline in Britain's economic preeminence, with unemployment exceeding 10%. Manufacturing moved to America and Germany. The trade surplus vanished. Britain borrowed to maintain its empire. Stage 3 was debt saturation. The costs of World War II destroyed Britain's finances. The country survived only through American loans. Stage 4 was confidence collapse. After the 1967 devaluation of sterling, international central banks began actively selling their sterling reserve for the first time since World War II. The average share of sterling in global reserve holdings collapsed within 2 years. Stage 5 was the end. Sterling lost its reserve currency status. Britain entered the IMF for a bailout in 1976. The empire dissolved. The pattern repeated exactly. America, the dollar dominance, 1944 to 2025. America's Stage 1 was post-war supremacy. Industrial production, the Marshall Plan, Bretton Woods, and the dollar backed by gold and American manufacturing dominance. The world needed dollars to buy American goods. Stage 2 began in the 1970s. In 1971, President Nixon suspended the convertibility of the U.S. dollar to gold, creating a fully fiat global reserve currency system. Manufacturing moved to Asia. Trade deficits became structural. America consumed more than it produced, but the dollar stayed dominant because oil, commodities, and global trade required dollars. Stage 3 accelerated after 2008. The 2008 crash had origins in massive liquidity injections by central banks from the mid-1980s onward, providing cheap credit that fueled excessive debt. The Federal Reserve responded to the crisis by lowering rates to near zero and injecting liquidity into the banking system. It worked temporarily, but the debt never went away. It doubled. Over the past year, national debt increased by more than $2 trillion. The rate of increase averaged several billion dollars per day. We are now in stage 4. Here is what most people don't understand. We are not preparing for a future crisis. We are inside one right now. The pattern is unfolding in real time. Stage 4 is not theoretical. It's measurable. The indicators are accelerating. Economists estimate the U.S. economy has a 39% chance of entering recession by September 2026, with unemployment forecast to climb to 4.6% bank rate. Forecasts show weakening output and rising risks across every major economy, with job market slowdowns and credit crunches expected medium. J.P. Morgan maintains a 40% probability of U.S. and global recession. These aren't doom predictions. These are probability assessments from institutions that manage trillions. But the real crisis isn't recession. It's debt dynamics. By the mid-2030s, interest payments could absorb nearly 1/3 of all federal revenue. The time required to add another $1 trillion of debt is accelerating, from 158 days currently to potentially less than 90 days by 2035. This is stage 4, the acceleration phase. Interest costs compound. Debt grows faster than GDP. Borrowing capacity erodes. And the world watches. Foreign central banks are moving. IMF researchers report that while the dollar remains dominant, its share has declined over 2 decades as central banks diversified into non-traditional reserve currencies. China, Russia, and BRICS nations are settling trade in local currencies. Gold reserves are rising. Dollar balances are falling. This is exactly what happened to sterling in 1965. Quietly, gradually, then suddenly. Markets are fragile. Current conditions display extreme asset valuations, unprecedented retail participation, and debt saturation. The same hallmarks that preceded 1929 and 2008. Stock valuations are stretched. Corporate debt is at record levels. Commercial real estate faces rollover risk. Elevated volatility and event risk through 2025 to 2026 require tighter risk management and heightened caution. Factually, this isn't fear, it's pattern recognition. We are standing exactly where Britain stood in 1965, where Spain stood in 1620, where America stood in 1928. Stage 4 always feels stable, until it doesn't. Let me show you what stage 5 looks like. Not speculation, not fear, just what the pattern predicts will happen if nothing changes. The trigger. It could be anything. A failed treasury auction, a geopolitical shock, a banking crisis, a sovereign debt default. In a financial crisis, the U.S. may no longer be able to borrow the funds needed to bail out financial firms. The trigger doesn't matter. The structure matters. When confidence breaks, it breaks fast. The cascade. Bond yields spike. The 10-year treasury moves from 4% to 6%, then 8%. The government's interest costs double overnight. Corporations can't refinance. Commercial real estate defaults accelerate. Regional banks fail. The collapse of asset prices precipitates the crisis, as excessive debt cannot be repaid. Stock markets crater. Not a 20% correction, a 50% collapse. The wealth effect reverses. Consumer spending implodes. Unemployment surges. The currency crisis. Foreign central banks dump treasuries. The dollar devalues sharply against gold, commodities, and rival currencies. Import prices explode. Inflation returns with force. Not 3%, 10%, then 15%. The Fed faces an impossible choice: defend the currency with higher rates and destroy the economy, or print money and destroy the currency. There is no good option. The social breakdown. Economies worldwide descend into global depression, coinciding with escalating social, political, and environmental turmoil. Pension funds collapse. Retirement accounts evaporate. Social programs become unaffordable. Political instability follows economic instability. Always. This is stage 5. This is what happened to Spain, to Britain, to every reserve currency in history. This is the point of no return, and we are one trigger event away. Now let me be very clear. This is not guaranteed to happen in 2026. Patterns show probability, not certainty. But understanding the pattern gives you an edge that 99% of people don't have. You now have a choice. Ignore the pattern and hope you're lucky, or recognize it and prepare. 3 moves. That's it. Move 1. Cash position in T-bills. Keep liquidity. Short-term treasury bills, 3 to 6 months. Not long-term bonds. When volatility strikes, cash is positioning power. You could buy assets at distressed prices while others panic. Move 2. Hard assets. Gold. Not as speculation, as insurance. Gold has survived every currency collapse in 5,000 years of history. It's not about getting rich. It's about preserving what you have. Physical gold. In your possession. Outside the banking system. If the dollar loses reserve status, gold reprices upward. Dramatically. Move 3. Productive assets. Own things that produce value regardless of currency. Stocks in companies with real earnings, real products, global diversification. Real estate in areas with strong fundamentals. Businesses that solve problems. The pattern shows reserve currencies collapse. Productive assets survive. What not to do? Don't panic. Don't sell everything. Don't hide in cash forever. This isn't about fear. It's about strategy. The people who win during stage 5 transitions are those who positioned before the crowd saw it coming. The pattern is clear. Stage 1. Build productive capacity. Stage 2. Overextend financially. Stage 3. Debt spiral. Stage 4. Confidence collapse. Stage 5. Currency crisis. We are in stage 4. 2026 might be the trigger. It might be 2027. It might be 2030. But the pattern doesn't lie. And those who understand it will survive what's coming. If this video showed you a pattern you've never seen before, subscribe. Because the next part of the pattern is already forming. And when stage 5 unfolds, you'll want to be prepared. This isn't doom. This is documented history. The question isn't whether the pattern will complete. The question is, will you be ready when it does?